everyone, to the CLS Market Review for the first quarter of 2014. I'm host Matt Harwell. The U.S. stock market posted another positive quarter, extending its 5-year bull market. Domestic large-cap stocks, as represented by the S&P 500, were up nearly 2% in the first quarter, moving its 5-year annualized return to over 21%. Interestingly, the market has produced a stronger 5-year return only about 5% of the time, going back to 1871. When this happens, the market generally produces below average returns over the next 1, 3, 5, and 10 years, though still positive. Domestic small-cap stocks and international stocks were both up 1%, while emerging market equities lost 1%. The bond market gained nearly 2% in the first quarter, even so slightly outperforming the stock market. As we begin this quarter's review, it's my pleasure to introduce a new face to our market commentary, CLS analyst Sierra Morris. Sierra joined our investment team this past summer. She recently graduated from the University of Nebraska at Omaha, majoring in portfolio management, finance, and banking, and was also involved in the Maverick Investment Club and the CFA Research Challenge. Sierra holds the Series 65 securities license and is currently working toward her CFA designation. In addition to her duties as an analyst, Sierra will be taking over my role as host beginning later this spring. So please join me in welcoming Sierra Morris.
Thanks, Matt. It's a pleasure to be here.
So Sierra, it's been a difficult few years for balanced, diversified portfolios?
You know, Matt, it has. And given that the U.S. stock market has been handily outperforming many other asset classes, many investors are starting to wonder if they should continue to stick with balanced portfolios. Earlier this week, I had the opportunity to sit down with our Chief Investment Officer, Rusty Vanneman, to discuss why we believe that investors should indeed stick with balanced portfolios. Thank you for being here, Rusty.
It's nice to be here.
So, given that the stock market in 2013 outperformed many other asset classes, including commodities, fixed income, and international stocks, I know a lot of investors are starting to wonder if they should maintain balanced portfolios. What do you have to say to these investors?
Well, I think investors should stick with balanced portfolios. Balanced portfolios work. The biggest reason why they work is that investors in balanced portfolios tend to have better investor experiences. And a big reason why is they're able to minimize something called the behavior gap. Something else about balanced portfolios is that investors are more likely to stay the course with a balanced portfolio.
Okay. So can you explain this behavior gap and how it affects the investor experience?
Yep. Well, there is an industry study called the Dalbar study, and they looked at returns over 20 years. And so over those 20 years, the stock market had an average return of about 8% a year. The average investor in the stock market during that time only returned 4% a year. That's a big gap. And the reason why there's such a big gap is because of the behavior of the investors.
That is a really large gap. So what can investors do to minimize this?
Well, it's something that advisors can do with investors is that I think there are a few things. First of all, have a plan. You've got to have a plan. Second, save more. Third, build a balanced portfolio. And then last, stay with that balanced portfolio.
Great advice.
Yeah.
Thank you, Rusty.
Thanks.
Thank you, Sierra and Rusty. We'll hear more from Rusty a little bit later in our program. Also, look for Sierra's first commentary as host on Tuesday, June 3rd. In the meantime, you're stuck with me. Let us now review key factors affecting our market outlook for the remainder of the year. Here with a look at current valuations, earnings growth, and interest rates is CLS Senior Portfolio Manager J.J. Schenkelberg. J.J.
Thank you, Matt. Whenever we look forward, we like to begin with a historical perspective. I invite each of you to review the chart Frequency of Historical Rolling 12-Month Annualized Returns, available in this quarter's PDF on clsinvest.com. This chart features various time periods dating back to 1871. Regarding the stock market, we remain cautiously optimistic. Earnings are above trend, which helps explain where the market is at, but it's not necessarily a positive moving forward. Expect earnings growth to fall back toward the long-term trend. Earnings have definitely improved in recent years. At the end of the fourth quarter from last year, earnings were $100 per share, which was a 16% year-over-year gain. Earnings are now above average. Average earnings growth is 5.9% per year and above trend. That helps explain why the stock market performed better than expected in 2013. Yet, it also suggests that the best gains for the stock market may be behind us. The strongest stock markets are usually when earnings growth is emerging from negative year-over-year rates to positive. And when year-over-year growth is 20% or more, the best stock markets have usually passed. Also of note is that the current market PE is about 18 times. This suggests the market may be overvalued given that the average PE at earnings peaks is 12.9. Investor sentiment is too bullish. Usually, when investor sentiment gets this stretched, forward returns tend to be below average. For a detailed look at our sentiment analysis, as well as our thoughts on the Federal Reserve, I again invite you to download our quarterly PDF.
Thank you, JJ. Our regular viewers will note that in addition to her insight, JJ makes an excellent game show host. Yet another reason to tune in for our weekly market review each Tuesday. We turn now to the bond market, and for this we go to CLS analyst Josh Jenkins. Josh.
Thanks, Matt. Regarding our bond market outlook, the long-term return prospects are uninspiring given the low absolute level of yields. Though risk may be overstated, we share the concerns that long-term prospects for bonds don't look great. Looking at this chart of long-term 10-year Treasury yields going back to the 1980s, yields dipped below 2% last year, but finished 2013 at 3%. The long-running bull market in bonds may finally be over, yet it's hard to decisively say that the bear market has begun, especially since yields fell during the first quarter. Nonetheless, we believe the best predictor of future long-term bond market returns is the current yield of the bond market. Given that 10-year Treasuries are less than 3%, the prospects moving forward just don't look that bright. Of course, this assumes that bond returns are only about interest rate movements, and that is definitely not the case. Credit risk, the risk that bond interest and principal might not be paid, is another key driver of bond returns. It's not probable that bonds will provide a return anything like they have in recent years. Over the last 20 years, for example, long-term Treasury bonds have had an annualized return of just under 8%. Over the next 20 years, it's going to be extremely difficult to match that.
Thank you, Josh. With this perspective on the markets, CLS continues to build portfolios around 4 investment themes: the power of innovation, high-quality focus, think global, and active diversification. For insights on how this impacts our positioning, we look to Manager of Investment Research, Paula Week. Paula.
Thanks, Matt. The stock market is an excellent way to participate in the economy's growth, and we expect that the economy will indeed continue to grow over our lifetimes, thanks to the power of innovation. We live in an entrepreneurial economy, where innovators are always looking at better ways of building new and improved goods and services. These innovations are the positive black swans that can drive positive breakthroughs in the economy and its long-term growth. We believe that corporate innovation will increase in the coming years as corporate executives become more confident in the economy and invest more for future growth. Industries that we believe will benefit include technology and energy. Overall, the economic case for technology is strong. Firms have underinvested and hoarded cash while profit margins continue to widen. Low corporate investment, executives confident in their balance sheets, investors looking for growth or yield, disruptive competitors looking for market share, and positive underlying trends all point toward expanded capital spending. Technology should be a big beneficiary. On the energy front, the U.S. is overtaking Russia as the world's largest producer of oil and natural gas. This was a result of an alternative drilling technique allowing for previously unreachable deposits of energy to be tapped. The U.S. has gained self-reliance by significantly reducing imports and helping narrow the trade deficit. Efficiency enhancements can be seen by an 8% drop of the number of rigs drilling since the early 2012 peak, while production per rig continues to grow and is up 28% over the same time period. For a detailed look on our thoughts on technology and energy as they relate to the power of innovation, I invite you to download our PDF. We would like to take a look at our themes of high quality and think global. For this, we go to our trading desk floor for a special word from CLS analyst Kosti Edis and portfolio manager Grant Engelbart.
Thank you, Paula. So, why high quality? Given our concerns about slower growth and rising interest rates, high-quality companies should do better. High-quality companies are also attractively priced. So what is high quality? These are companies that have higher profitability, relatively stable earnings, stronger balance sheets, and higher dividend growth. Dividend-growing companies are typically associated with high quality. Dividend stocks have outperformed the stock market since 1972 at 9.3% per year versus 7.7%. And dividend stocks that initiated and grew dividends outperformed all stocks with a 10.1% total return. Also, stocks with high dividend yield have been trading at a premium to those with high dividend growth.
Moving on to our Think Global theme, there are two strategic reasons to own international. First, non-U.S. equities account for over half the global stock market, representing a significant opportunity. And second, adding international equities to a domestic equity portfolio can reduce overall portfolio volatility. Our quarterly PDF looks at the tactical reasons to own international. I also invite you to review the weekly commentary given by Chief Investment Strategist Scott Kuby on March 24th. Here, Scott provides an in-depth look at opportunities in Europe.
Thank you, gentlemen, and thank you, Paula. One challenge we at CLS have seen investors face is how to diversify equity-dominated portfolios given unfavorable prospects in the long-term real returns of traditional fixed income. Here to discuss this is, once again, our Chief Investment Officer, Rusty Vanneman. Rusty.
Thanks, Matt. The solution to this challenge is found in our final investment theme, active diversification. We actively manage the diversifying exposures within fixed income and to a limited extent identify and utilize alternative asset class segments and strategies. Again, our return expectations for traditional fixed income are low. Interest rates are at historically low levels and may continue to stay relatively low in the years to come. Nonetheless, fixed income will continue to serve a valuable role to help manage overall portfolio volatility and to help buffer negative volatility in the stock market. Bottom line, fixed income still belongs in balanced portfolios. The key moving forward is to actively manage the traditional fixed income exposure. There are and will be opportunities to find relative value. For instance, one can manage a portfolio's interest rate sensitivity, otherwise known as duration. Currently, CLS is maintaining lower interest rate sensitivity than the overall bond market in anticipation of slightly higher rates in the quarters and years ahead. Another way to manage a fixed income portfolio is to take on credit risk, or in other words, have exposure to non-treasury bonds. While risks are higher, so are the yields. Currently, CLS believes that the yields are attractive enough to compensate for those additional risks. CLS is currently overweight corporate bonds. Meanwhile, alternative investments offer different styles of investing, ultimately seeking to enhance overall risk-adjusted portfolio returns. Some of the most common alternative investment ETFs utilize arbitrage strategies, derivatives, long and short positions, privately listed securities, and hedging. In sum, a balanced, diversified portfolio will be comprised of multiple asset class segments and strategies, including global stocks, fixed income, and alternative investments. Thank you for your time. Stay balanced. So Matt, we're excited for Sierra, but you will be missed.
Well, thank you, Rusty. I've been given an incredible opportunity to pursue a passion of mine, and my soon-to-be wife and I are moving to fabulous Las Vegas.
Well, congratulations. So are these the last few commentaries we'll see of you?
Well, let's never say never. And with that, we conclude our update for the first quarter of 2014. Our next quarterly market review will debut this July. Also, check back with us each Tuesday for our weekly and monthly market reviews. Each week, members of our portfolio management team will provide insight on our positioning and how we're specifically applying our investment themes. For all of us here, I'm your host, Matt Harwell. Thanks for watching, and thank you very much for your time and trust in CLS Investments.